This week, we're jumping into a real market puzzle. It's a huge Fed week, and on the surface, everything looks fantastic. But when you start digging, you find some serious risks hiding just out of sight. Let's get into it. So this is the big question, right? We've got the market hitting all-time highs, which should mean everyone is celebrating. But the mood feels incredibly fragile. The pros are telling a completely different story. So what is really going on here? Okay, so first, let's look at the good news. I mean, if you were just casually glancing at the headlines, you would think everything is just smooth sailing. It's all green light. And the number one reason for all this optimism is the Federal Reserve. Right now, the market is pricing in a 94% chance of a rate cut. I mean, that is basically a sure thing in Wall Street's eyes. And when the market is that confident it's going to get what it wants, well, the mood tends to be pretty good. And you can see that optimism written all over the charts. Both the S&P 500 and the Nasdaq have been pushing into brand new record territory. This is the kind of stuff you see on the front page, what traders call a strong tape. And to top it all off, you've got the VIX, the market's fear gauge, trading up above 15. Now that is considered calm territory. There's no big panic in the air. So we've got record highs and a Fed that's expected to play nice. What could possibly be the problem? Let's peel back that first layer, because this is where things get really interesting. See, beneath that calm, happy surface, professional traders are seeing a completely different picture. This quote really says it all. This is the key. Just because nobody is panicking doesn't mean there's no risk. It just means the risks are a little more subtle, and you gotta know where to look to find them. And this slide just lays out that disconnect perfectly. On the left, what we all see are those beautiful record highs. But on the right, what the pro playbook is warning about is that all this strength is actually pretty brittle, and a single piece of bad news could make it all disappear in a flash. The foundation just isn't as strong as it looks. So how do we actually see this fragility? Well, you have to look at what the pros are doing with their own money. And that means we need to understand two key ideas, something called downside skew and these things called zero-DTEs. Okay, let's start with downside skew. It's like they're smiling and telling everyone they're fine while quietly buying fire insurance for their house. The easiest way to think about this is like it's the price of market insurance. Even with fear being low overall, investors are paying extra for put options, which are basically bets that the market is going to fall. And the playbook calls this exactly what it is. It's a classic hedge before event setup. This isn't an accident. Traders are deliberately buying protection for their portfolios right before the Fed makes its big announcement. It's a huge tell that they aren't nearly as confident as they seem. Now, for our second warning sign, just wow. Look at this chart. A massive 60% of all S&P 500 options trading is now in something called zero-DTEs. This isn't just a trend, it's a fundamental change in how the market works. So what in the world are zero-DTEs? They're 0 days to expiration options. You buy them and they expire that very same day. Think of them as incredibly high-stakes, rapid-fire bets. What this means is that the market can now have these huge, violent swings based on a single headline that can completely disappear just minutes later. So here's the bottom line on this. This new world is great for super active traders who can jump in and out of these moves, but it's described as deadly for anyone who gets complacent. The market can lurch against you with insane speed and then snap right back before you even know what happened. But wait, it's not just about these quirky market mechanics. The risk this week is much bigger. It's global. It is not just about the US Federal Reserve. We have a whole lineup of the world's most important central banks, all making decisions one after another. I mean, just look at this schedule. The risk is just stacked day after day. It kicks off with US data, hits a peak on Wednesday with the Fed, And then we get potential aftershocks from the European Central Bank and the Bank of Japan. There is literally no time to breathe. It's a nonstop barrage of potential market-moving news. And as if all that wasn't enough to worry about, there's a wild card in the mix: energy prices. Geopolitical events, especially the strikes on Russian energy facilities, have made oil and gas prices really jumpy. This adds what traders call macro tail risk. That's the fancy term for a low probability but super high impact event that can come out of left field and just wreck everything. So you've got record highs, but a fragile mood. You've got hidden hedging going on. You've got a crazy global calendar. How on earth does a professional trader handle this mess? Well, let's take a look at the actual playbook from one trading strategy, Vex Alpha. The assessment is that this is a textbook buy the rumor, sell the news scenario. See, the market has already rallied on the expectation of a rate cut. That was the rumor. The big risk now is that once the news is official, there's no reason to buy, and everybody just rushes to sell and take their profits. So, given that risk, what's their big sophisticated move? The reported position is cash. That's it, nothing. We're taking zero risk, not betting on a rise, not betting on a fall. We're completely 100% on the sidelines. And the logic behind this is actually pretty powerful. Using proprietary volatility signals that provide a signal whether to hold risk on, risk off positions, or by holding cash. In this case, holding cash, you can't get blindsided by a surprise data point. You totally sidestep any turbulence coming out of Europe or Japan. You're completely protected from the potential for sell the news reaction. And maybe most importantly, you're just waiting for a clear signal before you put any of your money on the line. And that really brings us to the ultimate takeaway from this pro playbook. In an environment that is this complicated, this contradictory, maybe the smartest move you can make is just to not play. Sometimes protecting your money is the only goal that matters. And that's the thought I really want to leave you with. In a market that seems so calm, but is flashing all these hidden warning signs, maybe the winning move isn't about being bullish or being bearish, but just being patient.